Alec Walker, Managing Director of Crestmont Private Wealth. As we get closer to the end of the year, I wanted to provide an overview of tax loss harvesting. I'm sure many investors are looking at their statements and seeing those realized or unrealized losses and wondering if there's something that they can do to put those to better use and limit their overall tax liability. So tax loss harvesting is the process of selling securities or other capital assets that can reduce your overall tax liability. If you have gains in other areas, you could use a loss from other securities to reduce your overall taxable gain. Now, it sounds easy in theory, but there are certain rules and regulations set forth by the IRS that you need to be aware of to avoid those losses being disallowed. So we always recommend consulting a CPA or a tax advisor when considering this process. Capital gains and losses are different from income. There are some rules where a small portion of a capital loss could be used to offset ordinary income, but in most situations, this is the sale of a capital asset, a loss of a capital asset offsetting the gain of another capital asset. And for most investors, a capital asset are stocks, including ETFs, mutual funds, bonds, real estate, your personal residence or principal residence, or collectibles such as stamps, art, coins, things of that nature. There are other capital assets, but for most folks, the category would consist of these items. The capital loss process is a netting process. So the capital gains and losses are first grouped into different buckets. So your short-term gains and losses are in one bucket, and then your long-term gains and losses in another bucket. And so first, those losses are netted against each other. So you'll come out with your total short-term gain or loss, and then your total long-term gain or loss. So there could be a situation where you have both short-term gains and short-term and long-term gains, and there's no loss to offset those at all. And then finally, once you have those two short and long-term buckets netted out, they are then netted against each other to ultimately produce the lowest tax liability to the taxpayer. So we'll look at a quick example of how this would work. So for this sample investor, we've got a short-term realized loss of $5,000, a long-term realized loss of $15,000, a short-term realized gain of $1,000, and a long-term realized gain of $22,000. So we first separate those into the two different buckets. So the short-term loss of $5,000 reduces that short-term gain of $1,000, cancels it out. So we've got a net short-term loss of $4,000. And then we've got the long-term loss of $15,000, which will cancel out or reduce a portion of that long-term gain of $22,000. And so we've got a net long-term gain of $7,000. And then finally, that last step is we net those two losses against each other. So that net short-term loss of $4,000 reduces the net long-term gain of $7,000, and we're left with a net long-term gain of $3,000. So quite different than that long-term realized gain of $22,000 and short-term realized gain of $1,000 that we started with. So this can be impactful in reducing your overall tax liability. Now, in some situations, we could be left, if we had no long-term gains here, we could be left with a short-term loss of $4,000 here. And so that is a common situation and maybe something that investors will see this year. So there are carry forward losses, as well as the ability to offset $3,000 per year of your capital losses against ordinary income. So in that previous example, if we would have been left with $4,000 of a net short-term capital loss, we could have used $3,000 of that to offset against ordinary income this year, and then carry forward that additional $1,000 of short-term capital loss into the following tax year. So it doesn't disappear. And then finally, just quickly on wash sales and other rules to be considered. So a wash sale is if you purchase a substantially identical security either 30 days before or after the sale of the security. And this can be pretty specific when it comes down to even ETFs and mutual funds. You want to make sure that that security is substantially different. And that's why we do recommend consulting a CPA or tax advisor if you've got questions about this specific situation. And now if that happens, if you do encounter a wash sale, that's what's called a disallowed loss. So the basis, that loss is then added to the basis of the security that you purchased, and then the holding period is for that security is also added. So if you had purchased that initial security 5 years ago, and that becomes a wash sale, that holding period is then tacked on to the new security that you've purchased. If you have any questions about your specific tax situation as it relates to capital gains, capital losses, tax loss harvesting at year end, please feel free to reach out to us via info@crestmontpw.com. Thank you.